Did you commit to another CPA review course that just isn't aligned with how you learn? Well, spilled milk, baby. In the world of accounting, only one figure matters, and that's the bottom line. So by investing in Universal CPA Review, you're investing in yourself, and we promise to do everything in our power to get you the ROI that you're looking for by obtaining your CPA license. We know that purchasing a CPA review course is an investment, and we also know that spending all that money on a program that hasn't worked out sucks, and we want to soften that blow. Our Spilled Milk program will allow you to commit to Universal's Visual Learning CPA Review program at a steep discount. So reach out to info@universalcpareview.com to learn more about our program and what discounts you qualify for. Okay, so accounting change number 4. This is simply the correction of an error made in the financial statements, right? Spilled milk, baby. No point in crying over spilled milk. So let's just fix it and continue rolling with the punches. So what specific situations can result in an error that needs to be corrected? So one situation that the examiners love to sneak up on you is making a change from US GAAP reporting to non-US GAAP reporting. Okay, so a great example of this would be changes in US GAAP accrual basis of accounting when recording revenue, right? We're going to be recording revenue under US GAAP when revenue is earned. All right, but if we change that to the cash basis, and now all of a sudden we're going to be recognizing revenue when cash is collected, that would be a non-US GAAP method of reporting. All right, so that's not a change in accounting principle, right? It's not a justified change. This is an error. Right, on the surface, it might seem like a change in accounting principle because we're changing from one accounting method to another, but not going to be the case. It has to be GAAP to GAAP to be considered a change in accounting principle. If it is GAAP to non-GAAP, it's an error. Okay, so a couple of other errors that might show up, a simple mathematical error, right? Maybe we miscalculated inventory's ending balance or its cost of goods sold amount. Okay, so that would be a mathematical error. Could be an error in oversight. It could also be an error in bad faith. Maybe management is making an egregious estimate when it comes to how they are recording their estimated uncollectibles, right? There's this outstanding account receivable balance, and they think that they're going to be collecting 100% of this, when in reality, every year they collect at most 90%, right? That would be egregious. All right, so that is a possible error as well. All right, but bottom line is this could be any error as it relates to the presentation of the values presented in the financial statements, how certain items are classified, or how they are disclosed. That'll ultimately result in an error that needs to be corrected. So how are we going to correct these financial statements? Okay, so we have two questions here, the how and the when. The how is going to be just like changes in accounting principle. We're going to be making these changes net of tax. All right, so if you see an error that needs to be fixed and you see a tax rate, that's going to be your red flag, right? This needs to be an error that is corrected net of tax. Okay, so that is the how. How about the when? When are we making this change? What period are we making it in? Similar to changes in reporting entity and changes in accounting principle, we're going to be making these changes retrospective, right? Whoa, that's so retro, meaning we're going backwards to prior periods and we're going to be restating the financial statements for prior periods presented. Okay, so again, we need to ask ourselves, like we asked ourselves when we had a change in accounting principle, are the financial statements presented comparatively or are they presented for the current year only? Ultimately, there are two situations that you need to be mindful of when it comes to error corrections come exam day. And this is where it's really different from the other types of changes. Okay, so the two scenarios consist of a situation where the error is made in a year that is presented, and scenario number 2, the error is made in a year that is not presented, right? It comes down to comparative financial statements, or even just the current year financial statements. And it ultimately is a function of whether or not the financial statements are being presented. All right, so what we need to know is the two adjustments. We're either going to be restating the financial statements in the year presented, or we're going to be making an adjustment to beginning retained earnings for the earliest period presented. All right, so taking a look at these two examples, right? We have 3 financial statement years that are being presented in these comparative financial statements. We have financial statements for years 1, years 2, and year 3. And let's say that the error was made in year 1. What we need to keep in mind is we are presenting year 1 within our 3 years of comparative financial statements. So because the error is made in a year that is presented, all we need to do is fix the error, aka restate the financial statements for the year that is being reported, and we need to always do this net of tax. Okay, so let's say, for example, that the error results in an overstatement of net income. Because we're reporting the year one financial statements and the error was made in year one, we would simply just make an adjustment to the net income amount in year one. Okay, so no adjustment necessary to beginning retained earnings. We're simply restating the financial statements. But let's now say that the error is not made in a year that is being presented. Let's say that the years presented are comparative financial statements for year 2 and year 3. The error was still made in year 1, but we're not presenting year 1. Okay, so now what we're saying is we need to make an adjustment, but we're going to be doing this by adjusting beginning retained earnings for the earliest year presented. Still going to be net of tax. All right, we're not restating anything necessarily. It's not a simple fix. We're just going to go back and take the cumulative effect from the year 1 error, and we're going to adjust retained earnings by this amount. Okay, so let's take a look at this more robust example, and this is a little bit of a hybrid. Spilt Milk Inc. is presenting comparative financial statements for years 2 and 3. When presenting the comparative financial statements, the company discovered a mathematical error in recording sales for years 1 and 2, and this resulted in an overstatement of net income in the amount of $50,000 per year. And assuming the company reported net income in the amount of $500,000 and $750,000 in years 2 and 3 respectively, and the company has a 30% tax rate for both years, we're going to determine how Spilt Milk will make an adjustment to the errors made in previous periods and how net income should be reported for years presented. All right, so this situation includes an error that was made in year 1 and year 2. There's no error that is made in year 3. We're presenting financial statements for years 2 and 3. Okay, so step 1 is determining the necessary adjustments that need to be made, net of tax. Okay, so we know that we need to make an adjustment for the two $50,000 errors in years 1 and 2. Okay, so $35,000 after the 30% net of tax is going to result in our adjustment necessary. Now the question becomes, how do we report this adjustment? So what do we remember? If the comparative financial statement is presented, we're just going to make the simple fix. We're going to restate the financial statements for that year. Okay, so for year 2, we know that this is being presented. So we're going to go ahead and make an adjustment by restating the net income amount by reducing it by $35,000, right? We overstated it initially by the $50,000, but after tax, the adjustment would be $35,000. So net income would be adjusted to $465,000. The other financial statement that is being presented is year 3, but there was no error in year 3. So we don't need to make an adjustment to year 3 at all. All right, but there is a financial statement that is not being reported that has a necessary adjustment, right? Year 1 still had that $50,000 error. Net of tax, the adjustment is $35,000. What are we going to do with the $35,000 error that occurred? Well, because year 1 is not presented, what we're going to do is take the cumulative effect, that $35,000, and we're going to make the adjustment as an adjustment to beginning retained earnings in the earliest period presented. What's the earliest period presented? Year 2. We're only reporting year 2 and year 3. So we're going to adjust the beginning retained earnings balance by $35,000 in year 2.